In this video, we're going to walk through completing a pension worksheet for a firm with prior service costs. The following information has been provided for a defined pension benefit plan for the Rydell Corporation for the year 2017. Our beginning projected pension obligation before any amendment was $560,000. We had plan assets of $546,200. Gives us a net pension liability of $13,800. On January 1, 2017, Rydell, through an amendment to its pension plan, grants prior service benefits to its current employees having a present value of $120,000. Our pension benefit obligation settlement rate is 9%. During the current period, we have service costs of $58,000. We make contributions of $65,000. Our actual as well as our expected return on plan assets is $52,280. We pay benefits to retirees of $40,000, and we have $17,000 of amortization of our prior service cost in 2017. Let's go ahead and complete our pension worksheet for 2017. Let's begin by picking up our projected benefit obligation. Our beginning balance, we were told, was $560,000. Our beginning assets, we were told, were $546,000, which gave us our net pension liability of $13,800. Again, the net liability is simply our pension benefit obligations minus our pension assets. And in this case, we have a liability because our obligations are greater than plan assets. We are told that we're going to have $120,000 in prior service costs. And again, that's a change, if any, to our plan that increases employees' benefits due to prior year's service, not future year service, but prior year service. And again, this is arising from an amendment to our pension plan. So we're going to have adjusted beginning balances for our pension for January 1, 2017. Our liability balance or pension obligation will be $680,000. And of course, changing our pension plan doesn't change the assets. They remain at $546,200. We're told our current year service cost is $58,000. And again, that's the present value of future benefits that employees have earned during the current period. And of course, that increases our projected benefit obligation. Our interest cost for the period is calculated as our settlement rate, which we're told is 9%, times our $680,000 adjusted beginning pension benefit obligation. And of course, our interest cost increases our projected benefit obligation. Our actual return, we are told, is the same as our expected return, and it's $52,280. Our actual return increases our pension plan assets. During the year, we are going to start amortizing that prior service cost of $120,000, and we're told that our amortization in the current period will be $17,000. We have made contributions in the current period, we are told, of $65,000. When we contribute assets to our pension plan, that of course increases our pension plan assets. We are told that we paid benefits during the current period of $40,000, which decreases our projected benefit obligation, and we pay those benefits from plan assets. Let's go ahead and take a look at our journal entry for the year. Our pension expense for the year will be our service cost of $58,000 plus our interest cost of $61,200 plus our amortization of prior period service costs of $17,000, and we will reduce that by our actual pension returns of $52,280. So for our journal entry, we are going to have a pension expense of $83,920. Our cash comes directly down, $65,000 from above. Our balance for our journal entry for prior period service costs is going to be $103,000. And notice that's going to include a $120,000 debit. We've increased our expenses, and we've reduced them by amortizing some of that service cost of $17,000. So $103,000 is our ending balance. Our pension plan liabilities will be $121,920, and we're going to want to make sure that ties in with our ending benefit obligation and our ending plan assets. So, footing our columns, we've got $103,000 for our unamortized prior period service cost. We've got a pension liability now of $135,720. And again, that is our beginning liability balance plus our additional $121,920. And it's this $135 that should tie into our ending projected benefit obligation as well as our plan assets. Our ending pension benefit obligation is $759,200. We take our beginning balance of $680, we increase it by the $58,000 current period service cost plus the $61,000 in interest cost, and we deduct the benefits paid. Our plan assets will be the beginning balance of $546,200 plus our actual return of $52,280 plus our $65,000 contribution, and of course the pension assets are reduced by benefits paid during the period, which were $40,000. Let's now go ahead and take a look at our journal entry to record our pension expense. We've already started to accumulate our actual pension expense, and we calculated it on our worksheet, $83,920. So we've got the $83,920 in pension expense. Then we need to record our other comprehensive income, which was the debit of $120 and a credit of $17,000 for that net of $103. We paid cash of $65,000, and we had an increase in our pension liability of $121,920. So there's our journal entry. Note that on our worksheet we show the actual return on our pension plan assets, but if our expected and actual returns differ, then we're going to need to make an additional adjustment to record the proper pension expense. Let's consider part 2 of this problem. We're going to assume it's year 2018 and that everything is the same except that there is no prior service adjustment, so we're not going to have another $120,000 in prior service costs. The prior period service cost adjustment from 2017 would already be in place. We will notice have amortization of that prior period service cost, but we're going to assume we have no additional prior service cost. These assumptions are really rather lame because notice our beginning pension benefit obligation changed. So given our 9% settlement rate, our actual interest cost would certainly be different from the prior year. And we would expect, since we have a different amount in pension plan assets, our actual return on pension plan assets would be different as well. But just take these changes and see how we would roll forward the pension worksheet from one period to the next. The first thing we notice is that we pick up the asset and liability balances. Here is our beginning balance for our other comprehensive income. We've got our pension liability balance. We've got our pension obligation balance, and we've got our pension asset balance. And again, we were told that all of our actual annual pension expenses, interest cost, actual return, and amortization of prior period service cost are going to be the same in the coming year. So let's look and see how this rolls forward. Again, the service cost will increase our pension benefit obligation. The interest cost will increase our pension benefit obligation. The actual return that we earn will increase pension plan assets. Contributions will increase our pension plan assets. Benefits that we pay will reduce our pension benefit obligation as well as reduce our pension plan assets since they're paid from pension plan assets. So let's go ahead and calculate our totals here at the bottom and take a look at our journal entry for 2018. Our total pension expense is again $83,920. We've made cash contributions again of $65,000. Our other amortization of prior period service costs, $17,000. Our pension liability is the net of these items, $1,920. Our ending balance then for our other comprehensive income related to prior service cost, we had 103 beginning balance, debit balance. We have credited it or reduced it by an additional 17, so we're down to $86,000. Our pension assets will have a balance of $700,760. Our projected benefit obligation, $838,400. And now we want to make sure that our net pension liability should tie into our obligations and assets, as well as our beginning pension liability balance plus the increase in the liability that we've just calculated of $1,920. So it should foot in both those directions. So now we can take a look at our journal entry. We will have debited our pension expense for the $83,920. We are going to credit our other comprehensive income for the $17,000. We had an increase in our pension liability of $1,920, and we made a cash contribution of $65,000. In terms of the question, is Rydell's pension plan over or underfunded? Again, we have a liability on our books of $137,000 because our projected benefit obligations exceed our pension plan assets. So yes, we are underfunded.